Today I will be talking about the company Laurent Perrier. They sell champagne. We'll first start with net income. First, let's take a look at the net income. Here we can see that it grew from 23.7 million to 63.5 million, which is double the amount compared to 2020. We can conclude that sales are booming. EBITDA. Next, let's take a look at EBITDA. What is EBITDA? It stands for earnings before interest, taxes, depreciation, and amortization. This is actually the best way to see how well a company is really doing in terms of profit. In 2020, EBITDA was 16%, which was very high. But in 2024, we see a drop to 9%. This means that although the company revenue has increased compared to previous years, the profit has actually dropped by 5%. This is a significant difference as long as this remains positive. It means the company is still making a profit, which is the case here. Quick ratio 10. We look at the quick ratio. This ratio shows whether a company has enough liquid assets to cover its short-term debts without relying on inventory. What is a good quick ratio? It's good if it's higher than 1, which was definitely the case in 2020 when it was 1.5. But if we look at 2024, we see that it's only 0.55. This could become a big problem if all short-term creditors demand their money at once. Current ratio. Next, the current ratio is a financial ratio that measures the overall liquidity of a company. It shows if a company has enough short-term assets to cover its short-term debts. The same as with the quick ratio. A ratio higher than 1 is good. However, we see a significant decrease over the years. Looking from 2020 to 2024, it has even halved. Return on equity. Last but not least, return on equity, the ROE, is a way to measure how well a company is using its money to generate profit. It shows how much profit a company makes for every dollar invested by its shareholders. To calculate ROE, you divide the company net profit by its shareholders' equity. A higher ROE means that company is doing well at making money from its investment, while a lower ROE may indicate that the company is not using its money as effectively. We also notice that ROE has increased by 50% over the past few years, which is a positive sign. Finally, the conclusion. The question is it smart to invest in Laurent Perrier? My advice would be not to invest, even though they are currently making much more revenue. We have reviewed all the important ratios and we can see a declining trend. This suggests that the company is leaving a lot of potential untapped and shows that overall improvements are needed. Thanks for listening.